Hey everyone, and welcome. Today, we're diving into a really fascinating story about a company called Centum Electronics. They just put out a financial report that honestly is a bit of a head-scratcher. I mean, how can a company's sales be booming while they're also reporting giant losses? It sounds impossible, right? Well, let's dig in and figure it out. So right off the bat, here's the paradox in black and white. In their latest report, Centum's revenue shot up by a really impressive 21.5%. You see that, and you think, wow, things are going great. But then you look at the other number, and their net loss didn't just inch up, it widened a lot. So more sales are somehow leading to way bigger losses. And yeah, that brings us right to the big question we're tackling today. How on earth does that happen? It seems to fly in the face of everything you learn about business. But it turns out there's a very specific, very strategic story behind these numbers, and we're going to unpack it piece by piece.
All right, let's put some real figures on the table to see just how confusing this quarter really was.
Okay, so here are the hard numbers. The revenue for the quarter was over 3,300 million rupees. Solid. But then you look at the bottom line, a net loss of almost 618 million rupees. And just to give you some context, in the same quarter last year, the loss was under 193 million. So we're talking about the loss more than tripling. That is a huge jump.
So, what gives? Did the business suddenly fall off a cliff? Well, no, not exactly. The real story here is something the company is calling a strategic cleanup. It's all about taking out the trash, so to speak.
And to understand this, you need to know this little bit of accounting jargon. Exceptional items. Basically, think of these as financial curveballs, things that aren't part of the regular day-to-day business. They're one-offs. And in Centum's case, they just took a massive one-off hit, all at once.
And this table is great because it shows you exactly where that giant loss came from. It wasn't a death by 1,000 cuts, it was one giant, self-inflicted wound. The company wrote down over 2,000 million rupees, mostly by setting aside money to cover losses from its struggling businesses in France and Canada. You could say they decided to rip the Band-Aid off all at once.
And this wasn't an accident, it was a plan. The company's joint MD came right out and said it. This is all about cleaning up their global operations. The goal? Stop pouring money into these international units that weren't performing and instead bring that capital and focus back home to India where they see much bigger fish to fry. So, if they're cleaning house overseas, where are they putting all their chips? It's a huge bet on India's red-hot defense and aerospace market. Now, this pivot couldn't be better timed. They're basically surfing a massive wave created by the Indian government. With policies like Make in India and a big push for self-reliance in defense, there's a ton of money flowing to local companies that can build the high-tech electronics our military and space programs need.
And just look at the size of the prize. The market they're targeting now, what's called the ESDM market, is projected to be worth a staggering 7 to 8 trillion rupees in India by 2030. That is an absolutely massive opportunity, and it's what's justifying this whole painful cleanup operation.
But, and this is a big but, they are not going to be alone at this party. They're jumping into a very crowded field with some absolute giants. We're talking about the big public sector players like BEL and Hall, and of course private sector heavyweights like Tata and Adani. The competition is going to be fierce. Okay, so this is a high-stakes, all-in kind of move, and you can bet the market has noticed. So what do investors and analysts think? How is this all being reflected in the company's stock price? And here's the catch. The overwhelming consensus from analysts is that the stock is, well, expensive. It seems like the market has already given them full credit for this pivot being a massive success. The current stock price is reflecting a future that, frankly, just hasn't happened yet. They are being priced for perfection. This table just puts it in stark relief. Centum's price-to-earnings ratio is almost 130. That means investors are willing to pay 130 times the company's current annual earnings for one share. Now, compare that to the average for similar companies, which is around 34, or the whole industry average, which is about 18. It's a huge premium, and it's all built on hope for the future. Now, let's quickly look at who actually owns the company. You've got the founders or promoters, a mix of the public, and of course the big institutional funds. But you know what's more interesting than who owns the shares right now is how that ownership has been changing. And this is a potential red flag for some investors. Over the past year, the promoters' own stake in their company has dropped a lot, by almost 12%. So while the company is telling this big story about pivoting to a bright future, the insiders, the people who know the business best, have been selling. That definitely makes you go,
So, all of this, the big loss, the big pivot, the expensive stock, brings us to the final crucial question. What happens now? The company is truly at a fork in the road.
So here's what you need to keep an eye on. The bull case, the positive story, plays out if that revenue growth continues, if they start announcing some major defense contract wins, and most importantly, if they get back to being consistently profitable. On the flip side, the red flags to watch for are more quarterly losses, the founders continuing to sell their shares, and an inability to actually generate cash from the main business.
And really, that's what it all boils down to. Is this a brilliant masterstroke of a pivot that will unlock incredible value in the years to come? Or is it a desperate, high-stakes gamble on a stock that's just too expensive to justify? The jury is still out, but one thing's for sure. The next few quarters are going to be absolutely critical. And that's our explainer for today.
Okay, let's get into it. Usually when we sit down for a deep dive, I've got this, stack of articles, maybe a white paper or two. My desk is a complete mess. But today, it's strangely empty.
It is a bit different, isn't it? But, sometimes a single picture can tell a much bigger story than 100 pages of text.
That's exactly it. We are not reading today. We're looking. We have one single source, a snapshot of the daily candlestick chart for Centum on the NSE. That's the National Stock Exchange. And for anyone listening who thinks charts are, just red and green sticks, well, you're not wrong. But the story they tell is it's like a psychological thriller.
It really is. A chart like this, it's not just numbers. It's almost a crime scene. It shows you exactly where the fear was, where greed kicked in, and most importantly, where the smart money might be trying to hide its tracks.
Oh, I love that. A crime scene. So that's our mission today. We're going to play detective. We've sort of broken this down into 3 chapters. First, we have the slide, which is the painful part. Then the shift, where things stop bleeding. And then the fun part, the clues underneath.
The indicators. But before we get into all that drama, we should probably anchor ourselves, get the current coordinates.
Right. Good point. So let's set the scene. We're looking at a daily time frame. The ticker is Centum. And the latest price action right at the top gives us the headlines. We've got an open of 2374.00, a high that hit that exact same number, 2374.00, a low of 2325.000, and a close of 2351.00.
And that closing number, 2351.0. It sounds like just another number, right? But when you see where it sits on this chart in the context of the last 6 months, that number is heavy. It's a real line in the sand.
It feels like we're standing on a cliff edge. So let's start with how we even got here. Chapter 1, the slide.
The drama.
Exactly. The trauma, if you look at the left side of this chart, say back in September 2025, it's ugly. I mean, it is just a staircase going straight down.
It's a textbook downtrend. If you look at the y-axis, back then around that 03 SEP marker Centum was trading way up there, well above the 2560 level, probably pushing up towards 2868.
And then it's like gravity just took over.
Gravity, yeah, or just supply completely overwhelming demand. From October through November, you see this relentless pattern. In technical terms, we call it lower highs and lower lows.
Okay, explain that for someone who's not deep in the weeds with this stuff.
Sure. It just means that every time the stock tried to bounce, the bounce was weaker than the one before it. And every time it fell to a new, deeper low. It's the very definition of a bear market.
And I'm just seeing so much red candle after red candle. But there's also this red wavy line that's kind of snaking down with the price. What is that thing?
That looks like a moving average. Could be a 20-day or maybe the middle of the Bollinger Bands we'll talk about later. But its job in this part of the story is to act as dynamic resistance.
Dynamic resistance sounds like something from a sci-fi movie.
Well, it kind of acts like a force field for the sellers. Think of it as a moving ceiling. Every single time the price tried to rally look there in mid-October and again in November, it would pop up, hit its head on that red line, and just get slammed right back down.
So it becomes a psychological thing. Traders just see that line and hit sell.
Precisely. It's a self-fulfilling prophecy. Algorithms see it, humans see it, and they all use it as a signal that the downtrend is still in control. It shows there was zero conviction.
Nope, not yet. And that pushed the price all the way down to the very bottom of the chart, right around mid-December.
Yep, you see it near the 09 to tick and 22 to Sachs markers. The price really fell off a cliff there. It broke way below that 2252 dashed line and was testing the waters down in that 1944 to 2100 zone.
That feels like the point of maximum pain, capitulation.
It is, and that's usually where the psychology flips. When everyone who was ever going to panic has finally sold, well, there's no one left to push it down. And that leads us right into Chapter 2.
The shift. Okay, so this is right around the new year, Christmas 2025, into January 2026, and the whole personality of the chart just changes.
It does. The very first thing you notice is it stops making those lower lows.
Instead of sliding down, it's more like chopping sideways.
Exactly. We call that a consolidation phase, or a basing pattern. The market is basically trying to find the stock's fair value now that the panic is over. It's not falling anymore, but it's not exactly flying either. It's just bouncing between, say, 2,100 and 2,350.
And the candles look different. It's not a sea of red. It's green, red, green, red. It looks like a real fight is happening.
It's a tug of war. This is where the weak hands, the fearful sellers, are handing over their stock to the strong hands, the buyers who see value. And notice that red line, the ceiling we talked about.
Oh, yeah. The price is actually starting to poke through it.
Which is a huge deal. By late January and into February, it's not getting rejected anymore. It's trading above it, below it, sometimes resting right on top of it. That tells you the downtrend's momentum is broken. The bears are losing their grip.
Which takes us to right now, mid-February. The price is at 2351.1008, and it looks like it's trying to build a launch pad.
It is. But look very closely at where it is. See that dashed white line running straight across the chart right at this price? That's what we call static resistance.
So we swapped a moving ceiling for a fixed one.
You got it. The price is knocking on the door, but the door hasn't opened yet. There are sellers parked at that level, remembering it used to be a floor, and now they see it as a roof.
Okay, so that's the surface story. Stock crashed, found a bottom, and now it's stabilizing. But this is where it gets really good. This is the Sherlock Holmes part, looking at the clues underneath.
The indicators. This is where the real story is.
Chapter 3, the volume anomaly. I want everyone listening to just picture this. Look at the bottom section of the chart. The bar is labeled volume.
What do you see there?
Well, for months, September, October, November, December, it's just flat. I mean, totally flat. The bars are tiny, like a freshly mowed lawn.
Low volume in a downtrend. It's just a slow bleed.
Yeah.
But then what happens?
Then, right after the 2026 marker, bam! There is one solitary, massive green bar. It is a skyscraper in the middle of a field. It's taller than everything else combined, almost.
Then that right there is the aha moment. That is the single biggest clue on this entire chart.
So what does that mean? Just one day of insane trading.
It means a massive number of shares changed hands. Millions. And crucially, the bar is green, so the price closed higher that day. But here's the really subtle part. Did the price shoot to the moon on that day?
No. Looking at the candle right above it, it's a solid green day, but it's not an explosion. It stayed in the range.
Exactly. That combination, huge volume with controlled price movement, is a classic sign of accumulation. Think about it. Who has enough money to buy that many shares in one day?
Institutions. The
Yeah.
big players. Smart money.
Right. And if an institution just puts in a massive buy-at-market order, they'll send the price soaring and get a terrible entry price. So what do instead?
They hide it.
They use things like iceberg orders. They sit there passively and just absorb all the sell orders that come in at a certain price. They act like a giant sponge. You want to sell at $22.50? Great, I'll take it. You too, I'll take it. They soak up all the supply without making a scene.
That is amazing. So that green skyscraper is the footprint of a whale getting into the pool, trying not to make any waves.
That's a perfect analogy. It's an incredibly bullish signal. It tells you that someone with very deep pockets thinks the stock is a bargain down here. It's like a heartbeat on a flat line.
Okay, wow. So we have a smart money footprint. Let's move to the next clue. Chapter 4, RSI. That's the squiggly line in the middle pane, RSI 14.
The Relative Strength Index. Basically, it's a momentum gauge. It measures the speed and change of price movements. Think of it like a tachometer for the trend.
So walk me through what that gauge was doing during the crash.
Okay, look back in late November, early December. As the price was just getting crushed, that white RSI line dived and went all the way down and touched, even broke below that 29.00 reference line.
And when it gets that low, below 30, that signals what?
Oversold. It means the selling is exhausted. It's become irrational. The selling pressure has just run out of gas.
But then something weird happens. In December and January, the stock price itself is still bumping along the bottom, but the RSI line,
You see it?
the RSI line is actually going up. It's making higher lows while the price is going sideways.
And that, my friend, is called bullish divergence. It is one of the most powerful reversal signals you can find.
Okay, let's break that down because it's a little counterintuitive. Price is flat, but momentum is rising. Why?
Imagine a car that's been speeding downhill. That's the downtrend. The car is still moving forward, but the driver has taken their foot completely off the accelerator. The car is decelerating. The RSI measures that deceleration. So even though the price is still at a low level, the force of the selling is fading away fast.
The bears are running out of steam.
Exactly. The internal strength is shifting back to the buyers before you even see it in the price itself. It's a leading indicator. The engine is revving before the wheels start to turn.
That's incredible. It's like a secret conversation the chart is having with itself. And where is the RSI now in mid-February?
Right now, it's hovering around the middle. It's above that 53.50 line.
So healthy.
Very healthy. It's not oversold anymore, but it's nowhere near overbought either. It's in that neutral to bullish zone. The momentum has basically reset for a potential new move up.
Okay, accumulation volume, bullish divergence. Let's look at the guardrails. Chapter 5. The Bollinger Bands.
Right. Those are the two green lines that form a channel around the price. They measure volatility.
Back in September, during the fall, those bands were super wide. It was a 6-lane highway.
High volatility, exactly. Panic makes the bands expand. But now look at what's happening as we get into 2026.
They're pinching together. The highway is narrowing to a single lane.
We call that a squeeze. It means volatility is drying up. The market is getting quiet, compressing.
And like a coiled spring, compression usually comes before a big expansion, right?
That's the theory. Periods of low volatility are almost always followed by periods of high volatility. A squeeze is the market taking a deep breath before the next big move. The question is, which way?
Well, looking at the very last candles from February 16th, the price is pushing right up against the upper green band.
And that's a sign of strength. It's trying to push the envelope. Literally, it wants to break out. But, and this is a small detail, if you zoom in on that very last candle, you'll see a tiny wick on the top.
The wick. You mean that little line sticking out of the body of the candle?
Yes. That little line tells us that at some point during the day, the price went higher. It hit 23.74. But sellers were there to push it back down to close at 23.51. It's a small reminder that the battle for this level isn't quite over yet.
Okay, let's put all these pieces together. Let's synthesize this whole story.
Let's do it. Late 2025, Centum got destroyed. Fell from the high 2000s to around 2100. A brutal slide.
But then the bleeding stops around the new year.
Right. 2026 begins, the stock finds a floor, and then we see that massive, almost secret volume spike. That suggests the big money is accumulating.
Mm-hmm. And at the same time, we saw the momentum indicator, the RSI, start rising while the price was flat, a classic bullish divergence.
Correct. And now the volatility is squeezed tight, and the price is literally knocking on the door of that key resistance level around 23.51.
It sounds like the perfect setup. We are at a decision point.
We absolutely are. The so what here is that the market is coiled and ready. It spent 2 months building a base. The breakout, though, hasn't actually happened.
It's just waiting for a trigger.
Or it's just finishing the job. The smart money we saw buying in January, they're patient. They can wait weeks or months for their thesis to play out. They're not checking their phones every 5 seconds.
So practically, if you're watching this chart tomorrow, what's the key thing to look for?
You're watching 23.50. Plain and simple. If we get a strong, confident close above that level, say above 23.75, and it comes with another pop in volume, that's the confirmation.
That's the starting gun.
That's the signal that the shift is over and a new uptrend could be starting. That's when all the other traders who've been watching will pile in.
And the risk, if it falls.
If it falls from here, you watch that 22.50 level, a break below that would be a bad sign. It would mean this whole base is failing, and we might have to go back and retest those December lows.
But given all the clues, the volume, the divergence.
Given the evidence on the table, the probabilities favor the bulls. But, the market always gets the final vote.
It's like we've watched the hero's training montage, and now he's stepping into the ring, but the opening bell hasn't rung.
That's a perfect way to put it. The consolidation is done. Now we wait for the fight to start.
Which brings us to our final thought. The little what if we like to leave you with.
So we talked a lot about that giant volume spike in January. We're assuming that was smart money buying.
Right. The whales.
But think about it from their perspective. They bought millions and millions of shares somewhere around this 2,200, 2,300 level.
They've got a lot of skin in the game.
A ton.
Yeah.
So here's the question. The price has gone nowhere for weeks since they bought. Why haven't they pushed it higher yet? Is it because they're so confident they're just soaking up every last share? Or is it possible the selling pressure is even heavier than they thought?
Ah, that's an interesting tension.
Because if the price starts to slip back down towards 2200, all that smart money is suddenly losing money on a massive position. And there's nothing scarier than a panicked whale in a small pond.
If they have to get out, they become the sellers.
And they'll crash the price themselves. So you watch 2350 for the breakout, but you watch 2200 even closer. Because if that giant volume spike turns out to be a trap, that exit door is going to get very small very fast.
A trap or a treasure, that's what makes this so fascinating. You just have to play the odds.
And right now, the odds are whispering up, but it's always wise to know where the emergency exit is.
Well, I will definitely be pulling up the Centum chart tomorrow morning. That was a fantastic breakdown. Thanks for walking us through it.
My pleasure. Always fun to decode a good chart.
And thank you for listening to this deep dive. Keep your eyes on the charts, and we will catch you on the next one.